Hi everyone, welcome to our webinar. Why is SAP Fioneer CML Loans Management built different from other loan servicing solutions? First of all, I would like to introduce our presenter for today, Guillermo Punset, head of the Global Center of Excellence for Loans and Treasury. He holds a degree in computer science and has 10 years of experience as a senior SAP FS, CML, TRM, and banking consultant. Guillermo has collaborated closely with SAP and SAP Fioneer implementing SAP FS CML in different industries such as banking, education, finance, public and private sector in North America and Latam. Thank you, Guillermo.
Thank you, Andrea, and welcome everyone to this webinar. So today we have a very interesting question. How is CML different to other loan servicing solutions? CML, of course, being the consumer and mortgage loans module, which is also known as loans management from the banking suite. The reason for that is that it can actually manage loans different, all kinds of loans, not just consumer and mortgage. And we'll try to also understand what's the idea behind CML, what's the driving idea at the heart of CML that makes it so different and so sophisticated compared to other solutions. That's our objective for this webinar. Now, in order to understand how CML is so different, we'll need to go to the basics of a loan. So at the most basic, a loan begins with an agreement, right? At its simplest, a loan begins with an agreement between a lender and a borrower. So an amount is borrowed with several conditions, including, for instance, the interest rate, the start and end date of the repayment period, and so on, right? And once the loan starts, it's repaid according to a schedule. A loan repayment schedule is a representation of this agreement. It shows you how principal is to be repaid with interest over time. So a loan repayment schedule is probably the first contact anyone has with a loan, either being if you're a lender or if you have ever taken a loan, probably your first contact with a loan has been a repayment schedule. And it very clearly tells you how the loan should be repaid. So we have here a typical example. So we do have the loan amount, the frequency, the rate, the number of payments, and the payment amount. Okay, so this type of repayment schedule that we're seeing is a French amortization where you have the same payment throughout the period, the loan. This makes it really easy for borrowers because they won't have to be searching for exactly how much they should pay each period. It's very easy to the borrower, and you can see you have your starting balance, your interest calculation, your principal calculation, and your ending balance, right? So this repayment schedule is pretty much the genesis of the loan. It's your first contact when first searching and comparing for loans, and when you actually take a loan is also your reference on how the loan should be repaid, right? However, the repayment schedule shows you how the borrow amount should be repaid over time, and it's useful for the different parties, for both the lender and the borrowers, to understand and validate the calculations being made on the loan. But not only is it a visual representation in some cases, actually some lenders use the spreadsheets to both create the schedules and service their loans. We've actually had some customers over time that have had been servicing their loans directly on spreadsheets, and then moved to a more systematic approach. And you can see the appeal. You can see the appeal for managing or servicing a loan in a spreadsheet. Let's say you start humbly with offering loans to friends and family. It could be an appealing idea to manage this in a spreadsheet because anyone has an access to a spreadsheet, and you're very much in control of the calculations because you have all access to the formulas, right? So that's why you can see the appeal of why anyone would try to manage a loan with a spreadsheet, right? You can actually use, for instance, a spreadsheet's formula to the payment formula to calculate the periodic payment. And you can change all sorts of parameters and formulas in order to create your schedule. So that's the appeal of using a spreadsheet to start with. But already there are some limitations. For instance, if you were using, as some customers do before implementing CML, if you service loans with spreadsheets, you could have the limitation. You could have lots of limitations which will become apparent over time, especially as volume increases. Some very obvious limitations have to do with the spreadsheets themselves. You can have copy and paste errors. You could modify the wrong spreadsheet. You might not save the spreadsheet, and you might not actually update all of the values in the template you're using for creating or updating any particular loan. And also very important, over time, the reasons for modifications to a schedule will not be readily apparent. Organizations, that's why organizations using spreadsheets for loan servicing eventually move to a more integral solution. And this is very important. Either if an organization comes from a spreadsheet background, or it just or the repayment schedule forms the basis of their understanding of a loan, that repayment schedule actually is at the core of many of these solutions. So this tabular logic ends up being at the core of these solutions. In these loan servicing solutions, the repayment schedule is not only a visual aid, but it's actually the core of the business logic. Now, any loan servicing system that has these tabular logic with formulas that we saw on the spreadsheet example has a few limitations and some very important inherent complexities. So let's think about that spreadsheet we saw for a moment. If you wanted to calculate an extra item, for instance, a fee, you would actually need to add a column to that spreadsheet and provide a formula for it. Now, in a servicing system that is based on these tabular logic with formulas, you would also need to modify the code for this critical calculation logic to be able to calculate these new items. The typical limitations of systems that have these spreadsheet-like tabular logic at the core include that critical logic might need to be modified for new requirements. So again, if you need to calculate a new item or you need to do anything off the beaten path, you might need to modify the code for critical logic. A new item like a fee might also require changes across the entire system because you might add that additional item like a fee to the calculation, but you might also need to add it to reports. You might need to consider it in the counting. You might actually have to add it to account statements and so on. And the typical telltale of systems that are based on this tabular logic is this, that they have limited support for operations like advance payments. And they have limited support pretty much for any scenario outside the normal repayment. The main issue with a repayment schedule's tabular logic driving all of the loan calculations, it's that it might be too specific to certain scenarios. So think of it. Let's say business analysts create repayment schedules for different kinds of loans and provide those to developers in order to create a loan servicing system. But those scenarios might be too specific. They might not cover future products. They might not cover future necessities. And then eventually critical code might need to be modified in order to accommodate new items or new scenarios. So just how is CML different? How CML approaches this complexity of this problem differently? Well, the most important thing is that CML treats a loan like a fully fledged financial instrument with all its implications. And basically what that means is that CML has thought of all the possible cash flows that the loan can have. So what are all the possible outflows and inflows that a loan can have, and what are the reasons for them? CML has thought of basically all of the possible cash flows that can occur in a loan. At the heart of CML is a financial mathematics, FEMA engine, which calculates the cash flow based on loan data. CML is thus a cash flow-based solution where a repayment schedule does not drive the calculation of the loans. It's just a representation of the loan. This solution is much better geared to address the full spectrum of operation required from this financial instrument, and is obviously more flexible to adapt changing requirements. Now, let's try to visually understand what goes on in CML. So again, like we discussed earlier, many systems at their core have basically repayment schedules logics, right? They have this tabular formula based logic in their cores. But CML has actually FEMA, Financial Mathematics Engine, in its core. And what it does is it takes all of the loans information, like master data. You can take information about the specific product that has been created, obviously the loan amount, the maturity date, and so on, all the master data. Also loan conditions like the repayment frequency, the amortization type, which can be maybe a French amortization or straight line amortization, or even increasing payments. You can have different amortization types, the repayment amount and interest rate, and also transactional data like early payments or pay downs or loan increases that can happen over time, waivers and write-offs, rate adjustments, and basically any other transactional operation made on the loan. Now, FEMA takes all of this information and calculates its effects on the cash flow. So that means that there is not a fixed understanding of a loan like a repayment schedule that is saved upon creating a loan, but there is this dynamic calculation of the loan based on its conditions and its transactional data, and FEMA will calculate over time its effects on the cash flow, and it will calculate all the possible money flows, like outflows, which might be loan disbursements, which might be any other type of outflow, and money coming in, whether it is interest or principal or fees or anything else. This actually makes it really, really flexible. In simple terms, in CML, a business user provides the loan basic data, contractual conditions, and transactional data, and CML will calculate a cash flow based on them. the loan cash flow will change upon changes to conditions or transactional data like unscheduled repayments, changes in rates, etc. The loan cash flow has more information and is more dynamic than a typical repayment schedule. Flows can have different types and behaviors, providing more flexibility to operations like early repayments, payoffs, principal increases or decreases, rate changes, etc. So here we have a few screens from the system. So here you have pretty much all of the master data on the loan. You have a loan product. Loan product can have different behaviors and different conditions, of course. Here we have a loan amount, a commitment capital. We have the term, the loan term. We have the term start and term end, the maturity date. And we have, in this specific case, two loan conditions, a condition for nominal interest and a condition for principal repayment, okay? So here we have the rate, we have the payment, the total payment amount, and we have the frequency. This is a monthly frequency. And with this information, the system, FEMA, will be able to calculate a cash flow. So here we can see a calculated cash flow based on the current conditions on the loan. And you can see that CML has calculated a cash flow. So there is a planned disbursement, and then the repayments that should happen over time based on the conditions entered on the loan. Here you can see the interest and principal being calculated, and also all the data that was used to actually make this calculation. You can see the days in the calculation, you can see the start and end date for the calculation period, the rates, base amounts, and so on. Also, very importantly, we can see the flow categories. So I mentioned that CML has thought of basically all of the possible cash flows that the loan can have, both inflows and outflows. And CML has defined some very general categories of outflows and inflows, and you can use them as the basis of creating specific flows if you need specific fees or specific charges or any specific calculation for your loan. And that wouldn't require changes in the system coding. Now, let's see how the system behaves after a business operation, okay? So here we have the cash flow as it looks after being created with just very simple conditions, okay? With interest and principal. But how would the cash flow change if a business operation were made, like a payoff? So let's see. Here we're making a payoff. We're paying down $100 for this loan in this particular date. And we can actually, in the system, we can actually simulate what the effects would be on this particular cash flow. So you can see that there is we're simulating the cash flow with a payoff. You can see a pay down was entered in this particular date. And now you can see that the cash flow has changed. Now we have two calculations for interest. One that ends in this particular date, the 15th of January, the date of the payoff. And then another that starts on the next date. The reason for this change in the cash flow is that the base amount has actually been changed after the payoff. And FEMA makes it possible to have these dynamic cash flows, so you can have many operations like pay downs, increases, and so on, and the system will dynamically recalculate the cash flow without any changes to the system coding. So just as a conclusion, The last few years, as you know, have been pretty transformative in the financial services industry. Many requirements have been precipitated by the COVID pandemic, as well as rising inflation, like rate changes, like changing in the loan conditions that are some of the common requirements that we have today. Now, here is an idea that I want to leave you with. After today's talk, which kind of loan system would you choose for requirements like creating a new product or maintaining constantly changing loan products? Which kind of system would you choose for requirements such as the need of grace periods, payment suspension or rescheduling, or changes to loan conditions, maybe to include changes in interest rates, or origination and servicing through multiple channels? I think it's pretty obvious that a system that is at its core based on the tabular logic and formula logic of a loan repayment schedule are pretty limited and won't be able to handle most of these requirements. But a system that is based on a financials mathematic engine will be able to very easily handle any new loan requirement. Okay.